Good afternoon, folks. Welcome to the weekly economic update. It is Monday, August 29th, 2022. And you can see my buddy Jake back here. He's super excited for all the financial wisdom that is going to be provided today. So couldn't think of any good words. I'm not an English major. I'm a math guy. So I always, not that I struggled with, reading and writing and all that good stuff in school. I mean, I was fine at it, but just never really intrigued me. That's why I love what I do today, because I love math, and mostly financial planning is just a big math problem. So, whether or not it's planning for retirement or to buy a car, house, whatever the good, whatever good stuff people want out there, it's just, do you have the means to afford it? And, can you save up to do it? It's that simple. I mean, there's no wizardry when it comes to this line of work. So when you get into the investing stuff, sometimes even when charts look just perfect, things just don't work out the way you think. So, but the basics of financial planning, super simple. Anyways, glad you're here. If you're watching, and if it's your first time, please slam that subscribe button. Give me a big old thumbs up, like, share, all that good stuff. I would greatly appreciate it. Maybe share with a friend or family member. Maybe they enjoy my dry humor and sarcastic take on things. So anyways, kind of an ugly day in the markets again. Much better than Friday, obviously, but lots of red across my screen here. So there's couple of greens here or there, but for the most part, lots of red. So what we're going to go through today, going to go through the what happened in the market today, the weekly economic update, today's market recap, and then I got 3 articles. One has to do with interest rates, a post-dollar world. That's pretty interesting. And the Biden student loan fiasco. So that should be entertaining. So let's go ahead and jump in and take a look and see how the markets did today. Like I said, not very good. The Dow Jones finished down 0.57% or 184 points. I think it got as bad as maybe 200 points, but not much worse than that. Closed at 32,098. The S&P 500 was down 0.65, closed at 4031. NASDAQ was down more than 1% at 1.02%, closed at 12,017. Small caps were down 1.25%. Let's see, the VIX was up again today, 2.54%, closed at 2621. Moving over to the other Americas, Canada was down 0.19%. What's this? Brazil was up 0.02. Not, like I said, very few greens out there. Let's see here. Mexico was down 2.09%. Moving across the Atlantic, Germany down 0.61%, UK down 0.7%, France down 0.83%, Euro stocks down 0.92%, Netherlands down 0.96%. Kind of noticing the trend here, fellas and gals. Spain down 0.92%, Italy down 0.24%. What's that? Switzerland down 0.42%, and Portugal down 1.48%. Moving further east, here's a couple of those greens I was telling you about that are few and far between. In Russia, the MOEX was up 1.21%, while the RTSI is up 1.26%. Moving further east over to the Asian markets, Japan down 2.66%, Australia down 1.95%, New Zealand down 1.43%. Moving to China, the Shanghai was the lone bright spot, up 0.14%, while the rest of them were in the red. The SESE component down 0.34%, the China A50 down 0.96%. Actually, the DJ Shanghai was flat at 0, and the Hang Seng was down 0.73%, and the Taiwan weighted came in down negative 2.31%. So not the best day, but like I said, it is not unexpected. When we've looked at the charts over the last few weeks and months, we've been on that nice steady decline. I was trying to warn people as best as I could. This bear rally. I don't think we're going to exceed the previous highs, but others call it a dead cat bounce, whatever you want to call it. Just is not ideal for upward as far as wanting to put a lot of dry powder to work because unfortunately it got clobbered pretty good over the last few days. So, all right. Let's go ahead and read through this week's weekly economic update. The week on Wall Street, a comprehensive sell-off on Friday following comments by Fed Chair Jay Powell drove stocks to losses for the week. The Dow Jones Industrial Average tumbled 4.22%, while the S&P 500 dropped 4.04%. NASDAQ fell 4.44 for the week, and internationals were down 1.1%. Under pressure, stocks dropped on Friday following Powell's remarks reiterating the Fed's inflation-fighting resolve. While his comments did not break new ground, markets reacted severely, perhaps on worries that interest rate hikes may continue into next year. Let me stop there. Again, and I pointed this out quite frequently over the last, well, probably going back into like before the first of the year. Most of the financial journalists were already talking about, well, when after a short stretch, we'll raise interest rates for a while, and then we'll drop them back down. They're probably hoping for some quantitative easing in there too, but getting interest rates up to where they're at today, I don't think is, it may be putting a slight dent in the inflation numbers, but like the example I've used more than once. The Federal Reserve is the arsonist and also the fire department. And, it's like, if the fire chief was this rampant arsonist and he set your house on fire, but then he shows up and says, hey, I'll help put out that fire. And then he grabs a garden hose and is like, shh. It's like, don't you want to use the hose off the truck? I mean, this isn't really doing a whole lot. So, and that's the analogy I would use for what the Fed's been doing the last, going back 2 years ago, the Fed and cohorts with the federal government has created this problem by just dropping money out of helicopters, and I had to believe they had out of the 400 economists that work at the Federal Reserve, someone should have raised their hand and said this is a bad idea. But anyways, I digress. After starting the week sharply lower on renewed rising interest rates and economic slowdown fears, markets staged a modest turnaround beginning midweek. Stocks rallied on Thursday, sparked by a revised GDP estimate showing the economy shrinking less than initially estimated. Yeah, it went from 0.8 to 0.6, so nothing too dramatic. Thursday's rally also got a boost from regional Federal Reserve presidents who suggested future rate hikes may be in line with market expectations. It wasn't. Powell at Jackson Hole. In his much anticipated speech at the Jackson Hole Economic Symposium, Powell unflinchingly reaffirmed the Fed's commitment to raising rates to lower inflation, even if it results in causing pain to individuals and businesses. And then everybody freaked out. Wall Street focused on Powell's presentation in the hope that it might provide greater clarity on future Fed direction. Those remarks ultimately went no further than restating past communications. Powell commented, quote, "We are moving our policy stance purposely to a level that will be sufficiently restrictive to return inflation to 2%, end quote. That statement may have put to rest any thoughts that the Fed would soon pivot on rate hikes. And, you might see, people talk about the Fed pivot or the Powell pivot or, the Fed put. Typically what that means is anytime the economy gets shaky, the Federal Reserve and the federal government come right into the rescue, dropping lots of money to help everybody out. And who pays the bill? Taxpayers like me and you. Well, unless you work for the federal government, then you don't pay taxes. All right. So economic data coming up this week. Tuesday, we have consumer confidence and the JOLTS or job openings and turnover survey. Wednesday is the automated data processing report. Thursday is jobless claims and the Institute for Supply Management Manufacturing Index. And Friday, we have the employment situation and factory orders. Just 4 companies reporting earnings this week. On Tuesday, we have Best Buy and HP. Thursday, we have Broadcom and Hormel Foods. Chili. Good stuff. All right. Well, that's everything for the weekly update. Let's go ahead and jump over and read through today's market recap. S&P 500 cut losses on energy rally, but tech slump weighs. The S&P 500 cut the bulk of intraday losses Monday, but remained under pressure amid a slump in tech as investors continue to digest Federal Reserve Chairman Jerome Powell's recent warnings that interest rates will be higher for longer to combat above-trend inflation. The rout in technology from Friday continued into the new trading week, pressured by rising Treasury yields as investors priced in higher for longer interest rates following Powell's hawkish speech at Jackson. Powell suggested that the central bank would be willing to keep interest rates higher and tolerate a slowing economy to bring down inflation. With the Fed September meeting just weeks away, incoming economic data, including a fresh jobs and inflation, will likely sway the Fed's decision to hike rates by 50 or 75 basis points next month. Quote, should August inflation show a second month of cooling price pressures, at least some Fed officials will likely be comfortable with the lesser 50 basis point hike, end quote, Stifel Economics said in a report. Big names, including Apple, Microsoft, and Alphabet, fell about 1%. Netflix, meanwhile, is reportedly weighing up the option to launch its ad-supported streaming service at $7 to $9 monthly price, Bloomberg reported. In the ongoing Twitter-Musk legal saga, meanwhile, Elon Musk reportedly subpoenaed a Twitter whistleblower seeking documents to support allegations about fake and spam accounts on the social media giant's platform. Excuse me. Semiconductor stocks also piled on the pressure as midweek revivals seen last week following quarterly results from NVIDIA reversed. Monolithic power systems on semiconductor and AMD were among the worst performing chip stocks. Energy shrugged the broader market drop, driven by rising oil prices as investors continue to mull the prospect of major oil producers cutting output. In deal news, Walmart was flat after making a bid to buy the remaining 47% stake of South African retailer Massmart that it doesn't already own for $377.6 million. So that's the scoop as far as the skinny in the markets. Again, is it terrible news? No. Is it the worst? Is it great news? Certainly not. But my advice to folks is be prepared because things are probably going to get rougher than what we've experienced the last 2 years. And I mean, we could have probably avoided a lot of this pain if we didn't print $5 or $6 trillion and had just let people go about their lives during all the, madness of the last, since March of 2020. But hey, this is what people wanted. So you know what? I'm going to sit back and be fine. All right. Next up, rate fever propels dollar, wallop stocks and bonds. World stocks slumped on Monday as the growing risk of more aggressive U.S. and European interest rate hikes inflicted more pain on bond markets and pushed the dollar to a 20-year high as recession fears mount. 2-year U.S. yields surged to a high around 3.49%, the highest level since late of 2007, and far above the 10-year at 3.13. So yeah, it's not good when you got the yield curve inverted like that. I know I've talked about this a lot. Let's see. Yields also jumped across Europe. Federal Reserve Chair Jerome Powell said at Jackson Hole Symposium on Friday the Fed would raise rates as high as needed to restrict growth and keep them there for, quote, some time, end quote, to bring down inflation running well above its 2% target. European Central Bank Board member Isabel Schnabel added to market unease. She warned on Saturday that the central banks risk losing public trust and must act forcefully to curb inflation, even if that drags their economy into a recession. Investors waking up to the reality that rates would remain high, even as recession risk grows, sold off risky assets. European stocks fell 0.8% from their lowest to their lowest in over 5 weeks as Japan's blue chip Nikkei slid 2.7%. London markets were closed for the holiday, while the MSCI's World Equity Index fell 0.6 to a 1-month low. Quote, the message from Jackson Hole was loud and clear and not what markets were expecting, end quote, said Nordea chief analyst Jan van Gerijk. Quote, central banks need convincing evidence that inflation is coming down. That is bad news for the economy and risk appetite and raises the risk of a deeper recession if we get more rapid rate hikes, end quote. Investors ramped up U.S. and Eurozone rate hike bets with markets pricing in a greater chance of a 75 basis point hike from the Fed and ECB in September. Fed fund futures priced in as high as a 73% chance the Fed will raise 75 basis points and rates peaking at 3.75 to 4%. Again, I still think that's low. Quote, markets are focusing on discussing the message of, quote, coordinated tightening, end quote, from Jackson Hole as ECB and Fed appear to have recommitted to creating price stability. Yields are shooting higher and risk assets are quite a bit lower since last week, end quote, said Lars Suppresso Like Merklin, senior director at Danske Bank. Much might depend on what U.S. August payroll figures show this Friday. Analysts are looking for a moderate rise of 285,000 following July's blockbuster 528,000 gain. Hunker down. Investors hunker down for front-loaded rate hikes. Key gauges of equity market volatility shot up. The CBOE Volatility Index, widely dubbed Wall Street's Fear Index, rose to its highest since mid-July. The Euro Stoxx Volatility Index, the European equivalent, jumped to its highest level in 6 weeks. Quote, Chair Powell and the Fed make it clear that their job fighting inflation remains unfinished. Researchers at Morgan Stanley said in a note, quote, the path for stocks from here will be determined by earnings, where we still see material downside, end quote. I think we covered a lot of this already in other articles, so I'm going to go ahead and skip the rest of that one. So I'm already at 16 minutes, so I don't want to have this go too long. All right, next up, a post-dollar world is coming. And, like I've said for quite a while, I don't expect that the U.S. government and that the dollar will survive this decade. My personal bet is that somewhere between today and 2030, we will not have the same U.S. government that we have today. It'll probably, if it is still around, it'll probably be more of just the blue states. And I figure the red states will probably, leave the union at some point. And I'm actually kind of counting on it. But, and will the dollar survive? It's a mess already. So I'm not, I would not be shocked if it were to fall apart. So be nimble, folks. If you need to move into an alternative asset to, maintain those, your buying power, might start exploring those things today. All right, let's read through this. This comes from Rishir Sharma, and this is from the Financial Times. This month, as the dollar surged to levels last seen nearly 20 years ago, analysts invoked the old Tina, there is no alternative argument to predict more gains ahead for the mighty greenback. What happened 2 decades ago suggests the dollar is closer to peaking than rallying further. Even as U.S. stocks fell in the dot-com bust, the dollar continued rising before entering a decline that started in 2002 and lasted for 6 years. A similar turning point may be near, and this time the U.S. currency's decline could last even longer. Adjusted for inflation or not, the value of the dollar against other major currencies is now 20% above its long-term trend and above the peak reached in 2001. Since the 1970s, the typical upswing in a dollar cycle has lasted about 7 years. The current upswing is in its 11th year. Moreover, fundamental imbalances bode ill for the dollar. When a current account deficit runs persistently above 5% of gross domestic product, it's a reliable sign of financial trouble to come. That is true in most developed countries, where the episodes are rare and concentrated in crisis-prone nations such as Spain, Portugal, and Ireland. The U.S. current account deficit is now close to that 5% threshold, which it has only broken once since 1960. That was during the dollar's downswing after 2001. Nations see their currencies weaken when the rest of the world no longer trusts that they can pay their bills. The U.S. currently owes the world a net $18 trillion or 73% of U.S. GDP, far beyond the 50% threshold that has often foretold past currency crises. Finally, investors tend to move away from the dollar when the U.S. economy is slowing relative to the rest of the world. In recent years, the U.S. has been growing significantly faster than the median rate for other developed countries, but it is poised to grow slower than its peers in coming years. If the dollar is close to entering a downswing, the question is whether that period lasts long enough and goes deep enough. to threaten its status as the world's most trusted currency. Since the 15th century, the last 5 global empires have issued the world's reserve currency, the one most often used by other countries. For 94 years on average, the dollar has held reserve status for more than 100 years, so its reign is older than most. The dollar has been bolstered by weaknesses of its rivals. The euro has been repeatedly undermined by financial crisis, while the renminbi is heavily managed by an authoritarian regime. Nonetheless, alternatives are gaining ground. Beyond the big 4 currencies of the US, Europe, Japan, and the UK lies the category of other currencies. That includes the Canadian and Australian dollar, the Swiss franc, and the renminbi. They now account for 10% of global reserves, up from 2% in 2001. Their gains, which accelerated during the pandemic, have come mainly at the expense of the US dollar. The dollar share of foreign exchange reserves is currently at 59%, the lowest since 1995. Digital currencies may look battered now, but they remain a long-run alternative as well. Meanwhile, the impact of U.S. sanctions on Russia is demonstrating how much influence the U.S. wields over a dollar-driven world, inspiring many countries to speed up their search for options. It's possible that the next steps is not towards a single reserve currency, but currency blocks. Southeast Asia's largest economies are increasingly settling payments to one another directly, avoiding the dollar. Malaysia and Singapore are among the countries making similar arrangements with China, which is also extending offers of renminbi support to nations in financial distress. Central banks from Asia to the Middle East are setting up bilateral currency swap lines, also with the intention of reducing dependence on the dollar. Today, as in the dot-com era, the dollar appears to be benefiting from its safe haven status, with most of the world's markets selling off. But investors are not rushing to buy U.S. assets. They are reducing their risks everywhere and holding the resulting cash in dollars. This is not a vote of confidence in the U.S. economy, and it's worth recalling that bullish analysts offered the same reason for buying tech stocks at their recent peak valuations. There is no alternative. That ended badly. TINA is never a viable investment strategy, especially not when the fundamentals are deteriorating. So don't be fooled by a strong dollar. The post-dollar world is coming. So that's some ominous news, folks. I couldn't have said it better myself. All right. Last article up, Biden's student loan fiascos comes from Brian Westbury from our friends at First Trust Financial. And, before I even dive into this, I mean, what's funny is, a year ago, Nancy Pelosi was yapping at some news conferences saying, yeah, we can't do anything about student loans. The president can't just bilaterally or unilaterally, do a executive order and just make it disappear. It can't be done. It's not allowed. It has to go through the Congress. Not that I think the Congress has the ability to do that either, but hey. So I personally, I think what this is a way to throw a treat out there to the the lazy who don't want to pay back their bills, and so what that's going to between now and the election, there's probably going to be some lawsuits. Someone was standing, even though they claim that the taxpayer doesn't have standing, even though we're the ones paying it back. I'm sure someone is going to sue the administration on behalf of the people, and clog this up, and it'll be a perfect campaign. Say, oh, look at the evil conservatives, or basically non-Democrats, and they're trying to take away what we already have given you. And so I think it's more of a campaign strategy more than anything. But let's go ahead and read through this, and it's actually worse than what people had said as far as the way the incentives, or the incentives that it leads people down. So, all right, the Dow Jones Industrial Average fell more than 1,000 points on Friday, caused apparently by Fed Chairman Jerome Powell's attempt to use a brief speech to channel the ghost of Paul Volcker. Obviously, this was part of the market's worries, but the stage was set when the Biden administration announced a student loan forgiveness program last week. The more we learn about this, the worse it looks. The executive order would send an already Very bad student loan system, a system designed more to create jobs for academics than to really help students, into overdrive, generating huge costs for taxpayers, soaring college prices, and a massive shift in resources toward the already bloated college sector, which already generates negative marginal value added for both students and our country. I would agree with that 100%. No one really needs to go to college anymore. I mean, unless you're going to be a doctor, and I'd rather have a doctor that was mentored by someone versus, going to college and getting drunk and being an idiot. Let's see here. The Biden administration says that changes would cost $240 billion in the next 10 years. The Committee for Responsible Federal Budget says $440 to $600 billion. A budget model from Wharton says $1 trillion, but even that $1 trillion figure may be way too low. The key is that, as bad as it is, the cancellation of some student debt already exists is only a small part of the policy change. The much bigger change, and the one the market has finally begun to absorb, is limiting future payments on debts to roughly 5% of income, but only after the borrower's income rises above roughly $30,000 per year. For example, if someone makes $70,000 per year, then no matter how much they borrow, they're limited to paying back 2% per year, 5% of the extra $40,000. After 20 years, any remaining debt would simply disappear. Poof! Think about the perverse incentives. For the vast majority of students, choosing the income-based repayment system would be a no-brainer. And once they pick it, they wouldn't care at all whether their college charges $35,000 per year, tuition, room, board, and fees, $85,000, or even $150,000. In fact, students would have an incentive to pick the priciest college with the best amenities they could find and pay for it all with federal loan money because their repayments are capped. If you always wanted Rodney Dangerfield's dorm room from the movie Back to School, you're in luck. Awesome. That's one of my favorite movies growing up. Meanwhile, students would have the incentive to take out loans greater than what they need because they can turn the excess into cash for, quote, living expenses. Then they could use it to buy crypto, throw parties, or pretty much anything else. Who cares? The government would limit their future repayments. And here's what might be the worst part. Colleges would have an incentive to enroll students even if they have horrible future job or earnings prospects. By enrolling people, no matter how poorly prepared they are, a college can charge whatever they want and get huge checks from the federal government. And the unprepared students won't care because they really don't have to pay it back. In effect, colleges would create a massive, perfectly legal money laundering schemes. We're not legal experts and don't know whether the new proposal will be fully implemented, but if it is, watch out. College costs are poised to skyrocket, and academia is courting a political backlash of enormous proportions. Meanwhile, the market is attempting to digest just how far the economic reality of politicians have become. The political allocation of capital is a recipe for economic disaster. Well said, my friend Brian. It couldn't have typed that out any better myself. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. My email's right here on the screen, so you can send me an email directly. Also, my phone number, book a meeting, anything you want to do as far as doing some business, let me know how I can be of help. So, all right. Well, that's everything I had. I hope everyone has a wonderful Monday evening. There's no Astros baseball tonight, so I'll probably listen to some more podcasts over the weekend. I started listening to a lecture series from Murray Rothbard that was recorded back in 1986. It's about 30 hours. So if anyone's interested in that, let me know. I'll be happy to shoot you an email with the links. I think it's like 13 or so videos or recordings that you can either listen to on YouTube or your podcatcher if those tracks are available to you. So anyways, hope everyone has a great night, and I'll be back tomorrow. Y'all have a good evening. Bye-bye.